Well, good morning and happy Thursday. I know that Megan and I have a lot of information to share. We're going to be talking a little bit about what the Fed is saying, Powell specifically, recession. I know Megan's got tons of information that we need to know going into this weekend as far as where's inventory going? Are we still seeing more inventory? What does that look like for our buyers, especially our first-time home buyers? And what are interest rates doing? I've got a sweet surprise on that as well. So I'm going to start us out with our quote. I'm going to hand it over to Megan, who's going to go over into the real estate data, and then we're going to talk a little bit about what the economy is doing. So I know Megan and I love being together. Our energy level is super high when we are, but we are apart today, but she's bringing the energy. She's sitting outside. I'm a little jealous. But here's our quote that we're going to start out with. And I think it's really relevant. This study just came out this week. And it said, you can't predict the future, but you can best prepare for it, which is so interesting because I've been talking about, we have a lot of information right now. We have to start preparing. So this quote, you can't predict the future. I need coffee. You can't predict the future, but what you can do is best prepare for it. According to a survey of more than 1,100 US retirees, 70% of respondents wished that their younger selves would have saved more and started earlier to create bigger nest eggs for retirement. And then they also went on to say, don't forget to account for taxes and inflation because they will hit you harder than you expect. This is exactly why we stand up tall about real estate, why real estate is the best hedge for inflation, why the opportunities and the options real estate gives you, the earlier you can start is going to prepare you for your retirement. Whether you are helping your clients or you, most importantly, are helping yourselves to create a structured, financially sound, and secure retirement. With that, Megan, what is going on in the real estate market?
It's pretty insane to watch. Inventory is really climbing. And so if you've had those buyers that tuckered out back in January and February because they simply couldn't compete in such an extreme market, now's the time to really circle back to those buyers and sellers and get them back in the market because the market is still really good, but it's definitely calmed down substantially from where we were back in January and February. Now, even though rates are up, I've seen a couple of great posts on social media where you marry the house, but you date the rate. And so I'm hearing a lot of people that are going back and they're able to refinance later down the road. Potentially, if a recession hits, that means that it's good for interest rates, and interest rates tend to go down during a recession, that during that recession, they'll be able to refinance into a lower rate. And so again, it's a great time to circle back to those buyers right now and get them back in the market. I'll go ahead and pull up all of the numbers for you so you guys can see exactly what I'm looking at so that we can go through everything. This covers the week of June 15th through June 21st. And so this covers our first Juneteenth weekend. And so it was interesting to see how this 3-day holiday weekend would impact the rest of the market. And there was a substantial decrease in buyer activity this last weekend. It was great for those sales shoppers that wanted to get out there and try and put something under contract for less than asking price. There were definitely some strong negotiations that happened. But this last weekend, if we look at our heat map and the inflow and the outflow of new listings, this last weekend was our slowest weekend yet in terms of activity in the marketplace. And so the market really slowed down this last weekend. So again, a great opportunity for those buyers to get out there and get something under contract. This tracks the inflow and the outflow of new business, the odds of selling, month supply of inventory has come way up. We've also seen new listing. We've seen a slowdown in showing activity this last weekend and an increase in days on market. And so every time I tack on a new row to this heat map, it turns more and more blue, indicating that the market is becoming significantly less competitive than where we were back here in January and February, where we were sitting at 0.2 months worth of inventory. Looking at our average daily active count is now up to 4,479. And when I pulled that going into this weekend, we're up to 5,000 active listings. So we're adding about 500 new listings each week to the market, or 500 listings to the market that aren't going under contract in the first weekend. So our inventory is starting to stack up. We're still only sitting at 0.8 months worth of inventory, which is still squarely in multiple offer territory, but it's a far cry from where we were back here over Super Bowl weekend, where we dropped down to 0.2 months worth of inventory. As a reminder, when that number drops below 1, that means that multiple offers are highly likely in our marketplace. And so again, we've seen a big cool down in our market that's cooled substantially since Super Bowl weekend. New listings slowed this last last week by about 8.5%. We saw a big pop of new listing activity that very first week in June, right after kids got out of school. Right after kids got out of school, we saw our listing inventory boost. And again, we're starting to see about 500 new listings coming to market and sticking around each weekend. Back on markets rose by 8.6%. So we had 329. We're still only looking at about an 8 or a 9% fallout rate for listings that go under contract and then come back on the market. Expired listings sat at about 64% increase. And so more people are starting to pull their listings from market. Withdrawns fell by about 6.9%. Pending transactions fell by 6% over the last week. And it's down from the same week 1 year ago by about 21.8%, indicating that our cooling season hit a lot earlier this year than what we saw back in last year. Interest rates were so absurdly low through all of last year that we ended up seeing that we had an extended selling season while people, since rates started to go up back in January, we saw that act as a catalyst in our market and absorb a lot of our buyer demand early this year while buyers were trying to get into a home before those interest rates went up. And so again, we ended up seeing that our cooling trend, since our market was so early this year, we saw our market cool off a lot earlier this year as well. But 0.8 months worth of inventory, and we're now sitting at about 4 times the amount of inventory that we had back in January and February. So again, get those buyers that tapped out of the market earlier this year back into the market, because again, you can marry the house, but you can date the rate and hopefully refinance later down the road as things start to cool off. Our odds of selling, which is where I take into account all of the available homes for sale in the market versus those that go under contract and or close in the same month, dropped down to 66.6% or 66%. And that's about where we were pre-COVID for all price ranges before we really ended up seeing our market really spike over the last 2 years. And so again, with Juneteenth weekend being a 3-day holiday weekend, I expected that number to go down. We'll see if we have a rebound going into this weekend, since it's not a 3-day holiday weekend, if that number rebounds. What was interesting to see is after Memorial weekend, we only had a very minimal rebound after that market, after the market came back after Memorial weekend. So again, we could see this number continue to slide as we go deeper into the summer months, now that we've hit past summer solstice. If you have listings that you're sitting on and you're trying to decide, do I want to list now or do I want to wait until September and October? I would say list it now, because we still have more units that go under contract in June, July, and August than we do in September, October, and November. So I would still advise you to get that listing to market as soon as possible. And it's really time that you need to start setting seller expectations that you might not be under contract in that first weekend. I'm hearing a lot more properties that are sitting on the market the first weekend and not getting any showings that very first weekend. And so again, we're seeing a lot of people that are choosing to wait until the second weekend to see if those homes stick around on the market, to see if they could come in at a full price offer rather than being in that multiple offer situation. So people are waiting around a little bit longer before they're putting properties under contract. We're still a far cry from a market imbalance. We were up to 14.1% of a market imbalance, which is up from the 3.5% of a market imbalance back in January and February. But 14.1%, that number is climbing. We're still not headed into anything where we would see a housing bubble or anything that we would get close to worry about home prices falling, other than seasonally at this point. There is somewhat of a market correction going on where we're seeing people pricing their properties about 5 to 7% off of where they were in the peak back in January and February. But again, we're not seeing anything more than just a market correction due to interest rates and a seasonal correction that we end up seeing every year. But again, in order for a market to burst, we would need to have an oversupply of homes. So we'd need to be a lot closer to that 31,000 level for active unit count for us to be at a market imbalance. We need to be oversupplied with homes for a market correction to take place, more than a 6-month supply of inventory. We need to have a lack of equity in the market. We are flush with equity right now. We're experiencing double-digit appreciation still year over year at this point, even though we've seen prices fall in just the last month. And then we would need to have that coupled with some sort of economic widespread hardship, which is just not existing, that would cause a severe loss in jobs. We're still only sitting at about 3.5% for our unemployment rate right now. So unemployment remains really strong at this point. Showings dropped down to 3 shows per property last week if you put it up over a holiday weekend. I always tell you, don't list over 3-day holiday weekends and don't make price reductions over 3-day holiday weekends, because you end up taking a hit and you suffer for longer days on market. It's harder to get people to come through these houses when we have these 3-day holiday weekends, especially over this one being a new one with Juneteenth. The weekend before it was sitting about 4 shows per property. And so we'll see if that number bumps back up again going into this next weekend. This is showing data. I'm still not able to get any broker bay data out for you. And so we could add one, maybe one more showing to the property. But again, I had a client that reached out to me earlier this week that said we only had 4 showings on a $2 million listing that was in Wash Park. And I said, it's taking a lot longer to get people through these houses. We're not seeing the same rate of showings that we were seeing back here in January and February, where it was 20 to 25 shows per property. And so again, it's 3.1 shows per property. Based on data from last week, it was about 11.4 showings should yield you a contract. So if it's taking about 12 showings to go under contract and you're getting about 3 shows per week, that means that you could be on the market for as long as 4 weeks. I'm also suggesting that people wait before they make price reductions because it's taking longer to get people through their houses right now. Instead of making a price reduction right up front after the first week, waiting until weekend 2 or 3 before making that price reduction, because again, you want to make sure that you get enough people through that house before you go through and start slicing off your prices. So again, waiting a little bit longer to make those price reductions to make sure you get enough people through those houses. Median days on market popped up to 7. And so we ended up seeing that 3-day holiday weekend ended up having an impact on how long properties were spending on the market. And it was on the market for about 7 median days last week, with half of the homes under contract in that first 7-day period. And that's up from 5 the weeks before. We're out of the time where it was listing on a Thursday, going under contract by Monday. And so again, we're looking at about 7 median days on market right now. The rate of price reductions also increased, and they tend to increase over 3-day holiday weekends, but it was 27.6% of all the homes that went under contract last week made a price reduction, which is up from where we were back in January and February, where it was only about 5.6% were making price reductions. We're seeing significantly more price reductions on the market now, as people are adjusting their prices to compensate for the more inventory coming into the market. But 70% made no change to their prices whatsoever. And so again, still a lot of homes that are going under contract at great prices. The average price reduction ended up going up, and it was a 5.8% price reduction this week. So we ended up seeing that there were bigger, deeper cuts to prices in this last week, or an average of a $44,000 price reduction off of the original price from the market. So again, we're starting to see bigger, deeper price reductions, which is a different trend than what I had experienced before. Usually when we go through a market shift, I see more widespread price reductions at smaller amounts. Now I'm seeing bigger price reductions at bigger amounts. And so again, that's a kind of a shift in the market that I'm starting to note. But a 5.8% price reduction is pretty substantial. For homes up to 500,000, we ended up seeing that our market started to cool really back after Easter weekend. Odds of selling really started to decline this last week. We're up to 0.4 months worth of inventory. There's been more downward pressure on this market as people are getting priced out of higher priced properties. If I was going to buy a $700,000 house now with interest rates being at 6.25, we're now seeing that people are maybe buying a $500,000 house instead of buying that $700,000 house like they would have at the beginning of the year. So more buyers have pushed down into this bracket, keeping month supply of inventory at 0.4 months worth of inventory, which is still up from where we were over Super Bowl weekend, where we only had 0.1 months worth of inventory. Our average daily active count came up by 17.3% in just the last week, and it's up to 801 total units that are available for sale in this market. New listings fell by about 17.8%. Back on markets increased pretty dramatically at that 54%. We're still only looking at about 8 or 9% back on market from a pending status. We're looking at expired listings ended up going up to 112% more than where they were last week. We saw 34 expired and 34 withdrawn. Pending transactions ended up declining by about 3% over this last weekend. So again, not a great idea to list over a 3-day holiday weekend. The odds of selling still remained pretty high, but it dropped over a 3-day holiday weekend. It came down to 76.2% odds of selling, which is where we were. It was still better than what we saw over Memorial Weekend. Memorial Weekend, it fell down to 74.1% odds of selling. I expect that this market under $500,000 is likely to have a slight rebound this next weekend as we get out of this 3-day holiday weekend. We only have 7.3% of the inventory that we require to offset demand. So again, this market is still moving pretty quickly, not in danger of seeing a market burst or anything that would warrant a housing price correction in this market. Last week, if you put up a new listing, you should have seen 6.4 shows per property. That's down from the previous week by about 13.9%. So again, showings fell over 3-day holiday weekend. Not a great idea to make price reductions or put new listings up over these 3-day holiday weekends. 6.4 showings or 12 shows should yield you a contract, so it could take as long as 2 weeks for you to go under contract in this market. Median days on market popped up to 5 median days on market. And so again, we're starting to see days on market stretch out a little bit longer. So hopefully you're not at the mercy of the MLS every single morning and you're looking at what hits the market every morning and trying to get your clients to go out and look at properties over the lunch hour. Hopefully you're able to wait until the weekend to get out there and go look at those properties. So giving you some more time control. This is the market that we've all been praying for 2 years. We all just have to make adjustments to the way that the market works now, because it's not as fast and furious as it was back in January and February. As of this last week, for units that went under contract, 1 out of every 5 were making price reductions. So again, it was about 20.6% of the homes that went under contract last week made a price reduction. And the average price reduction for this price segment also went up. It was a 5.7% price reduction, or about $24,000 off of the original asking price in this particular price segment. For homes between 500 to $1 million, we're now looking at our most loan dependent section of our market, where it's about 80% of all the homes in this market require some sort of financing to go under contract. Our cooling trend really set in after Easter weekend, and it continued to cool, and it became our bluest week so far this year, even more so than what we saw back after right after the new year. It's become more blue and significantly less competitive in our marketplace. Our average daily active count came up by 13.2%. Or it's sitting at about 2,800, 2,900 active units available for sale. New listing count decreased week over week by about 2.4%. Back on markets declined by 1.7% with 172 units that fell out of, or that were in a previously off market status that came back on market. Pending transactions fell this last weekend by about 5%. So again, it's not quite the same chunk that we see taken out for Memorial weekend. Our next 3-day holiday weekend is going to be July 4th, and that takes a big hit as we come out of those 3-day holiday weekends. So again, don't want to list over July 4th for that particular weekend. But our month supply of inventory is now up to 0.9 months worth of inventory. So we're almost out of multiple offer territory in this market as well. When that number is below 1, it means that multiple offers are likely. But again, it's been coming up. It's up 18.9% week over week. It came up from 0.8 to 0.9. So that number is likely to continue to rise as we get deeper into the summer months. The odds of selling continued to fall. We didn't see a rebound after Memorial weekend. We didn't see a rally in this market where the numbers came back up. So I didn't see a surge of activity directly following that 3-day holiday weekend, but it's up to 64.3%, which is back to where we were post or pre-COVID. We were sitting at about 64 to 68% odds of selling as we went through our summer months. So we're back on pace with where we were about 2 years ago at this point. We're sitting at about 15.7% of the inventory required to offset demand. Still not a market that we're looking at for a correction here in this particular case. So we don't have an oversupply of homes. So we're not worried about a big correction taking place or housing prices to really fall substantially. Showings really dropped off this last weekend. We only had 2.5 shows per property this last weekend. And for units going under contract, it's about 10 showings should yield you a contract. So it could mean as long as 5 weeks on the market for a home between $500 to $1 million right now. Median days on market popped up to 8. So we added 2 extra days to our time frame to listing these homes. So about half the homes were under contract in 8 days or fewer. The rate of price reductions was 1 out of every 3. That was a pretty substantial jump in the rate of price reductions this last week. So 1 out of every 3 homes is choosing to make a price reduction. Typically in the month of June, we end up seeing that it's about 25% of homes make a price reduction. So the rate of price reductions is up a lot higher than what we would typically see for June. People making adjustments for being off of peak season at this point. The size of the price reduction also went up. It went up from 4.9% to 5.4% this last weekend, or about a $40,000 price reduction in this particular market. For homes between 1 to 1.5 million, again, the cooling trend really set in after Easter weekend. We ended up seeing that the odds of selling slowed to our second slowest week of the year, based off of data going back to the year to date for 2022. Looking at all of our month supply of inventory, we're up to 1.2 months worth of inventory. So now we're out of multiple offer territory. That's up from the 0.4 that we experienced back here, back at the beginning of February. And so we're sitting at 1.2 months worth of inventory, which means that we're out of multiple offer territory for 1 to 1.5 million. Our average daily active count came up by 11% just in 1 week to 464. A pending transactions fell by 8.4%. So again, we typically see over these 3-day holiday weekends that higher end markets end up taking a bigger hit over these 3-day holiday weekends than we do at the lower end of the market. And so this market really cooled down going through Juneteenth weekend. The odds of selling ended up falling to about 60.7%. It's still better than where we were pre-COVID. Pre-COVID, that number hovered around 40 to 45%. So again, we're still up about 15% from where we were about 2 years ago. So again, it's still a great time to sell. We just have to make adjustments and set proper expectations because it's going to take longer to sell these properties than where we were over the last couple of weeks. 13.6% of the inventory required to offset demand, so we're not in danger of having a severe market correction in this particular market. 2.3 showings per property if you listed over Juneteenth weekend. Before that, we were hovering around 3 shows per property per weekend. So again, we're still looking at a lot fewer shows per property versus what we were back over January and February, where we were looking at about 12.4 shows per property. This week, it was about 12.3 showings should yield you an offer. 12 showings to yield an offer is pretty common at all price ranges right now. And so again, if you're getting about 3 shows per property per week and it's 12 showings to go under contract, you could be on the market for as long as 4 weeks at this point before you go under contract. Median days on market stretched out to about 7 median days on market, and about 17.5% of the homes that went under contract last week made a price reduction. The price reductions were really substantial, with about nearly a 9% price reduction, or $125,000 off of the original asking price. We're starting to see bigger price reductions take hold at higher end markets. In the $1.5 to $2 million market, again, the cooling trend really started to set in over Easter weekend. We had our coolest weekend of the year going through this last weekend over Juneteenth. Month supply of inventory shot up to 2.3 months worth of inventory, which is up 80.4% from where we were in the previous weekend. Our average daily active count is now sitting at 4.7, up 4.7%. And so our average daily active count, we've got about 177 units for sale any given day in this $1.5 to $2 million mark. With pending transactions fell week over week by about 41.9%. So again, not great to list over these 3-day holiday weekends, not great to make price reductions over these 3-day holiday weekends, but we've got roughly 3 times the amount of inventory that we had back in January and February now in this particular market. The odds of selling ended up dropping from 58.3% last weekend to 51.6% this last weekend over Juneteenth weekend. So again, a big dip in the odds of selling. We'll see if there's a rebound that happens after Memorial weekend or after Juneteenth weekend going into this next weekend. We're sitting at about 18.9% of the inventory required to offset demand in this particular market. So we're still not looking for a market correction to take place, even as inventory is on the rise pretty significantly in this particular price range. This last weekend, we were looking at about 1.5 shows per property. It was about 2 shows per property per weekend the weekend before. Where it was about 15.1 shows to go under contract. So again, if you're getting about 2 shows per property per week and it's about 15 showings, it could take as long as 7.5 weeks for these homes to sell in the $1.5 to $2 million price point. Median days on market stretched up to 10.5 median days on market, which is up from the 8 median days on market that we saw last week. 38.9% of these homes ended up making a price reduction. So pretty substantial price reductions right now in this particular market. And the size of the price reduction ended up going up really high. We saw a 12.8% price reduction, or about $262,000 off of the original asking price for homes between $1.5 to $2 million. So really substantial price reductions in the higher end of the markets. I'm seeing similar activity happen in between 2 to 3 million, and from 3 million and up, we're seeing really large price reductions that that are taking place right now, as well as inventory coming way up in those particular markets. What I'm recommending right now at this point is that patience is key. It's going to take longer to get these homes under contract, so you really have to manage and set your seller expectations. And so with homes taking longer to sell and longer to get people through these properties, again, I'm recommending that you're waiting a little bit longer before making price reductions. Wait 2 to 3 weeks before making a price reduction, rather than making that price reduction after the first week, because the market has really slowed down quite a bit. So again, it's taking longer to get people through these homes. So have patience. Patience is key in making sure that that home is beautiful and turnkey and staged and ready to go, because those are the homes that are still flying off the markets out there. That's all I have for you, Deborah. It looks like we have a couple of questions that popped up.
You did. Well, Stephen was talking about the Castle Rock, that he had no showings on a listing he put on the market at 7:30. But Anthony asked, sorry, this might be a stupid question. There are no such thing as stupid questions. But what is the AVG daily active?
So average daily active count.
Yep.
So how many average listings are available for sale on a daily basis during that particular week?
Perfect. Buyer appreciation or buyer applications down. Steve, I'm going to show you that in a minute, and that's actually going to surprise you. So if you're good, Megan, I'm going to go ahead and share my screen. Let's do this.
Take it over.
Oh, you have to allow me.
Yep. Let me do that.
Absolutely. So
We
in the
forgot that step.
Well, that's because I logged in at the very last second. I had computer issues, and I'm just really hoping that my laptop doesn't freeze up, but we'll see.
There you go.
Fabulous. All right, so here we go. Let's share and talk about what's happening. So yesterday, Fed Chair Powell talked to the Senate committee. You know, he's got 2 days where he does this after each following every meeting. He testified that the central bank plans to keep raising their Fed rate. So when he says interest rates, he doesn't mean the 30-year fixed. He means their Fed rate until there's clear proof that inflation is slowing, even if that means moving into a recession, which is really interesting because he went on to say that we never said it was going to be easy or straightforward. He said that yesterday. But on March 2nd, he came out on market and he said, it is more likely than not that we can achieve a soft landing. So which is it? I mean, we've been seeing this, and this isn't a big surprise. Obviously, his message is changing as the environment is changing. But to come out and say that he never said that it was going to be easier, straightforward is a little bit of it's a senior moment. We're just going to stick with that. So yesterday he is saying that we're going to do whatever we need to do to encourage inflation to come down, even if it means that we're going to head into a recession. Recession has become, or it is a major Google search term now. It's 4 times higher than it was just a couple of months ago in February. So one of the very respected economists came out, Larry Summers, talking about he expects a massive recession to the point of over 5% unemployment. Now, I mean, if you kind of scroll down, he really is dark and dreary. And there's been some people that have come out against him. But in his darkness and in his dreariness, if we look at a 5% unemployment rate, we know that unemployment bouncing upward is the telltale sign that we are entering into a recession. There is a lot of economists, many of them saying that we're going to enter into a recession, but many of them differing on how deep, how long, how wide this recession is really going to be. Many talking about the fact that these people that are going to be unemployed are more probably those who were most hurt also by the pandemic, which is awful in so many ways, but it really is that renter pool versus the buyer pool. And I say that because obviously it impacts what we do on a daily basis. So let me just show you really quickly. So if we look at unemployment and recessions, we know that during each recession, you can see the lines, historically, every single one of them, unemployment goes up. So what he's saying isn't unheard of. It's just the amount to which we're going to see unemployment. Now, for right now, the initial jobless claims are really still very strong. In fact, they were down by 2,000. So the initial jobless claims actually are showing to be stronger, which just talks to the resiliency of our job market. And in fact, the 11.4 million job openings is certainly helpful. So we're not there yet, is what I'm saying. So we're just continuing to watch these jobless claims. And of course, we'll see the unemployment number the first week of every month, every first Friday of the month it comes out. We got a nice little, I said there's a nice surprise coming for interest rates. We got a little gift. So overseas in Europe, they saw their manufacturing, their PMI index, right? We talk about that here. We talk about the manufacturing index. And is it telling us that the costs of goods are higher or lower? What is transportation doing? What is their ability to hire doing? There's a whole chart that I've been sharing as we're watching it. Is it speeding up faster? Is it slowing down? Is it moving in the right or the wrong direction? Well, overseas, they actually came out with their PMI, their manufacturing numbers, and they're showing a slightly softer price appreciation. So it's not deflation, right, any more than we're seeing a depreciation, but it's a softening of the inflation. That's good news, really good news. So it actually overnight helped our bond market. So we saw the bond market tip almost back down to 3%. Remember, it had topped over 3.25%, which pushed our mortgage rates to 6.25%. So now that we're seeing those come down, we're actually seeing interest rates come down. So this morning, we were back down to about 5.875. So we're seeing our rates now back in the 5 handle. Love that. So we're going to continue to watch this today and tomorrow, and hopefully going into this weekend, we can get some folks under contract with a little bit more of a push into their affordability. Can they go a little bit higher based on these interest rates, just giving us a little bit of a gap? Now, do I expect this to be a new trend line, right? Because that's what we keep talking about. I don't. I believe that we're going to go into a sidewards motion. There's still a lot of fear. There's still a lot of unknown. As the Fed continues to move the Fed rate, it is not the Fed rate that is going to push our interest rates up, but it's the economy by which and their ability to control inflation. So as we see this, we're going to see a lot of volatility in a sideward motion until we get to a point to where we see a recession. But for right now, interestingly, the mortgage purchase applications just came out this morning showing that they were actually up. Or actually, it came out yesterday. Today's Thursday. Came out Wednesday. They're showing that they were up. They were up 8% week over week. Now, this doesn't account for what we're seeing today. Remember, so this is last week when we were seeing interest rates climb. Freddie Mac just came out with their interest rates as well, and they went up, right, to almost that 5.88, just under that. And remember, they include a discount point. Again, this isn't today, but we're seeing even with the rates jumping up, the mortgage purchase applications were up 8% last week and the week before. Now they're only down 10% year over year, which is really good. Just a month ago, we were down something like 21%. Now we're down only 10%. So there's a lot of buyers that are looking at this going, I know that home prices are higher. I know that interest rates are higher, but I anticipate that home prices are going to continue to go up because we know long-term real estate always goes up. And as Megan said, you date the rate, right? So you're locking in that purchase price. You're not locking in that rate, not forever. Because the good thing about a recession, you don't want to say that there's a ton of good things about a recession, but there is. The good thing about the recession is the fact that during recessions, interest rates actually drop. So if we look at the past recessions, we actually see that they drop significantly from 18 to 13, 11 to 8.75, and most recently even 3.75 to 2.75. That was obviously due to a pandemic. But we see interest rates drop during recessions. We are counting on that. And that's going to continue to provide those people that lock in the home prices today the opportunity, which is why mortgage purchase applications for ARMs is up. Now it's 10% of all applications are going for an ARM loan because people are willing to take on that risk. Now, I will say an honest conversation about the risk needs to be had because although this is historically accurate, we can't foretell what specifically and accurately is going to happen in the future. We can only forecast that. Nobody's crystal ball is 100%. So will interest rates drop and how much? So going into an ARM, you have to respect the fact is, can I afford this rate and this program if rates don't go down? And at the end of this presentation, I'm going to talk to you about a 2-1 buy down and show you the numbers on that. That might give you a very similar solution for a short-term rate while still at the same time giving you the stability and the security of a 30-year fixed. All right. Existing home sales are down. We talked about this. Megan showed us about what's happening locally. This is obviously part of what we're looking at towards this recession watch. To see existing home sales drop, you're starting to see demand drop. We've been talking about the fact that we're trying to control or calm consumer demand, right? Because they can't fix the supply issues. The Fed can't, not with raising the Fed rate, but they can cool demand. So we're seeing that nationwide, yet home prices are staying up. In fact, prices marked 123 consecutive months of year-over-year price increases, even with home sales going down. And it's primarily because inventory, while coming up, is still historically low. We saw that locally. We're certainly seeing that nationally. We're nowhere near where the normal is. And as Megan said, we want to relish in this, right? We've been needing this and wanting this, yet the turn of events is still fearful, and it still takes getting adjusted to, right? Having those conversations. Getting back to a 30 days on market is not awful, but it's not 4, and it's going to take some time to get used to that. We're also expected, if you read what some of the economists are saying about what's happening, and of course, Powell talked about this. I talked about this last week, where Powell started to talk about all of this pent-up construction. We know that we have like 9 months of inventory in the new build sector. 6 months of that is not yet completed. It is not able to get actually to market due to the lack of supplies, the increase in cost, whether it's buyers backing out, whether it's the inability to get to labor, whether it's permitting. Lord knows, it just took me 5 months to get a permit from Denver for my daughter's house. All of this is costing builders time. But eventually, that inventory is going to come to market. And so there is an expectation that later this year that we are going to see some of that come back to market. Now, remember, new inventory, new build inventory is like 10% of the market. So it's not going to fulfill our needs, but it is going to be a nice addition. And this is, of course, nationwide. Equity gains, because we've been seeing all of this increase in appreciation, we of course are seeing this increase of equity gains. This report just came out as well. In fact, it came out on Friday, was the day after our last market trends update. I did include a little bit of this on the Saturday blog, but I wanted to touch on this again because it continues to go to the strength, having all of this together so that you can share it on social, talking about, we know we're heading into a recession. We are not afraid of heading into a recession. You see some of these pictures online right now about us heading into a recession. It is literally pictures from the 1920s. It is literally pictures of this massive depression with these massive lines, food lines or job lines. That is not what we're going to see. We have the stability of housing. We are going to see struggle 100%. I have no doubt. I don't want a recession. I don't want the economic or the economy to slow down, but we need to slow down demand so that supply can catch up. But in the meantime, those who own homes are in the best position when and if that happens. Right now, so we just got this report on Friday, talks about the first quarter over the first quarter last year. Americans had gained 32% in equity. Now, this includes appreciation and principal reduction. So we're going to remember, and of course, almost a third, 62%, 62% of homes have a mortgage on them. So 38% don't even have a mortgage. So just a little bit over a third. So all of that is included in this. So the National Homeowner Equity, Coloradoans gained 92,000. So to see this increase is even well over the last time we saw this equity gain report. So 92,000, a phenomenal opportunity for Coloradoans about options, right? Whether or not they want to sell, you're not going to trade a house like you trade a commodity, like you trade Bitcoin or stocks. Take advantage of the opportunities. If it's up, sell it, right? Buy on the dips. Sell on the ups. You're not going to sell it just because you're up, but it gives you options. It gives you the stability that what if I do lose my job, right? And I can't make that mortgage payment. am I over 62? Can I reach in and can I get some of that equity? Can I stop making a mortgage payment? Maybe I can't qualify for a cash out or a HELOC. Maybe I do have to sell and turn to renting for a period of time, and putting $100, $200, $300, $500,000 in my savings account to hold me over until I regain employment. It's about options, right? Or maybe even downsizing. Maybe I bought that vacation home that I was really excited about, and now because I lost a job, I need to sell that property, but still maintain my primary home. So Coloradans gained $92,000. Negative equity declined nationwide. Colorado, only 1.5% of all of our homes have negative equity. By metro, 1.3% of the Denver metro specifically has negative equity. And if I look nationally at the delinquencies, meaning late on my mortgage payments, that dropped from almost 5% to 2.7% in the last year. People are saying that I'm going to protect this. Right? This is my nest egg. This is my safety net. This is my ability to have options in retirement. 2.7%. That is remarkably low. Here in Colorado, I've shown this chart. We're down at 1.7. We're very strong. And just for giggles, I pulled out the most recent forbearance chart. It is 0.85% of all loans, not even all homes, because remember, we just talked about the fact that now almost 40% of homes are owned free and clear. 8.85% of those who are mortgaged are still in forbearance. It's just ridiculously low. The stability of our housing market is strong, right? And we're going to have, and I know this, and you know this, real estate is hyper local. I talk about a lot of the numbers, but we know that there are some areas that maybe push values up too high. And if something happens, and if a major company in that area does a series of layoffs, because there's actually a website now, it takes me back to the days when we had the implodometer for mortgage brokers, where we were actually watching them implode in 2008, 9, and 10. Now there's a layoff website where it's actually showing all the companies that are laying off. There are companies that grew big, that took advantage of opportunities in the last 2 years, that now need to right size. So when they're doing that, there's actually, obviously the whole watch on that. The stability and the surety in the housing market, knowing all of this is going on, is going to continue to give your buyers, your sellers, and you the opportunity to know that this is where we build the strength. This is the market we need to stay in tune with. CoreLogic even came out saying that while we might see an uptick in distressed sales over the coming years, because real estate is hyper local, because some areas will see a reduction in prices, especially if they're in those areas where companies are doing major layoffs. And so while we'll see an uptick in distressed sales over the coming year, historic home equity gains should keep those sales from reaching any kind of elevated levels, anything that's actually going to put us into any kind of a housing crisis or housing bubble or bust. Locally, we might see some price drops, but nationally, we're going to continue to remain very strong. And certainly Denver, we're going to continue to remain very strong. So household equity is actually up to 27.8 million. Trillion. 27.8 trillion is the homeowner equity. And this chart does include those homes that were that are even owned free and clear. So it just takes the total household values less the mortgages held. We have 27.8 trillion. Again, stability. 10.6 trillion of that is in senior housing. I want to hold on to that for just a minute, and I'm going to come back to it. We know, and we can continue to show historically, I'm not just making this up saying the housing market is super strong and it's going to remain super strong. Historically, we've shown where housing values either kept their value, went up, even during the stagflation period, they went up 1% every year, that now we're seeing that consistently during recession periods, those home values continue to go up. I would expect they're going to slow way down. I've even talked about, so some economists are saying that they are expecting, with the gain in inventory that we're seeing, that we're going to see appreciation of 0% next year. I would love to see that. I don't think it's going to happen. Even in 2018, we saw an increase in interest rates. We saw an increase in inventory here in the Denver market, and we still saw over a 2% price growth that year. That's good. I can live with that. I can live with 0 for several years while we allow supply to catch up to demand and allow demand to normalize. So while we're looking at this, we know we're continuing to stay in the right place. As we look towards our opportunities, as we look towards the options that the real estate equity has given us, it is your job to be that advisor for your clients, to lean into where they are in their life cycle. Are they seniors at this point? Are they over the age of 55 or 62? Are they looking to gift a house or to help their children? Maybe they know that by the time their kids come back from college or come back from that first job, they're not going to be able to afford to live in Denver. So they want to support and provide that home for their child today. That child can be a primary home. They can gift that equity. Or if they're seniors, they can look at reverse mortgages. I want to talk about those things just for a second, because the opportunities with equity is the conversations we need to be having. As much as you're going in strategically with the data, and I hope you are, and all the charts that Megan is sharing specific to the zip codes and to the areas and the price points for your listing appointment or your buyer appointment, you should also be thinking about, how do I also advise them as far as the equity that they have and the options it opens up. It's not to say that you have all the answers. It's just, look, I know that real estate provides so many options. I want to discuss these with you, not to influence you in any way or to have you go in that direction, but to open up your eyes to some opportunities and options that might present as your equity continues to build and as your life events come near. So if you'll just indulge me for a few minutes, I'm going to talk to you about this, and then you can, continue with your buyer seller conversation. Anyway, so here's some food for fodder. The gift of equity. We just put out a video on this yesterday talking about the fact that you can give a gift of equity to a family member. A lot of people know that it exists, or maybe they don't know that it exists. And I know that there's tax implications on this. There is a $16,000 per year per person tax or gift tax exemption. So as a mom and a wife, I can give my daughter $16,000 tax-free. My husband can give my daughter $16,000 tax-free. If she's married, I can give him $16,000 and my husband can give him $16,000 tax-free. If they have two kids, I can give one kid $16,000. My husband can give one kid, and the same with the fourth kid. You can start to multiply this for one house purchase, completely avoiding the gift tax. You also can apply it to your lifetime gift exemption, which is tied into the estate tax exemption, which gives you up to $12.06 million. Now, if you're gifting more than $12 million, you and I need to sit down and have a conversation, right? That's not where most of us are. So you're going to be well within the lifetime gift allowance. You need to talk to your CPA about this and make sure that he is in alignment with the way we're thinking about this. But the gift of equity is an incredible opportunity to support your children, your niece, your nephew, your grandkids. I was at a Rotary meeting. We were presenting, Gabe Bodner and I, who does our reverse mortgages, and we were presenting to a Rotary meeting. And one of the gentlemen there, he just, oh my God, my whole heart warmed up. He had like 12 rental properties. He had already given one of his rental properties to his nephew. He gave one to his Rotary. I mean, he's starting to give away some of those properties because he only needs so much income as he continues to age. You talk about being able to gift, right? To be able to have that legacy. Home ownership allows you to do that and to give them a head start. I helped all three of my kids purchase their first home. If you have multiple homes, or maybe you're in a home that's too small and you want to be able to give that to your kid, knowing that they want to move back to Denver one day, and then you go buy your next property, that's a strategy we need to talk about if you have clients in that situation. The other thing is that reverse mortgage, that retirement strategy. I'm not going knee deep into this. This is a whole conversation. Gabe Bodner was with us last week. Hopefully you watched our whole 2-hour Agent Ignite. Megan and I kicked it off, and then Gabe Bodner finished it. Better yet, invite Gabe Bodner into your office to sit down and have that conversation with everyone, to look for opportunities. As we know, the baby boomers are aging. You cannot escape death. I hate to say that out loud, but it is very true. If I can't escape death, I don't even like saying that. What are my options, right? I have 24 doors. What are my options when I start getting there? How do I take my money and allow the equity in my house and allow it to help me capitalize on the kind of lifestyle I want in retirement? So I'm thinking about all of these as a strategy, right? Having all these strategies in your tool belt so that you can continue to communicate with your clients in a way that you're their advocate, their advisor, not just their real estate agent, not just their lender, right? But their advocate and their advisor. So this is an incredible presentation that he gives. I swiped 3 of the slides as a teaser, but really it's about the opportunity that if I had $1 million and I just allowed the historic run of the market and I was only drawing 4% a year to live on, which isn't very much, right? I don't know about you, but I don't want to live on just 40,000. But if I limited it to that 4%, then I'm going to watch that value go down significantly. I'll be left at the end of 22 years with about 1/3 of that, versus if I use a reverse mortgage, a retirement mortgage, and I only pull money out of that reverse mortgage on the years when the stock market is down, I actually end up with more money. I end up with 1.3. And you're like, yeah, but you took money from your house and you took that loan. It's a reverse mortgage. Well, yes, you did, but you actually can pay that back and get a tax deduction. Hello. In a high year where the stock market is doing fantastic, you can take extra money, pay off that interest on your mortgage, and get a tax deduction. So you're not paying all of those taxes and the capital gains on that stock market. So that's exactly what we were talking about in the very first slide. Taxes can hit you more and inflation than you think it will. I mean, we all think I'm going to make less in retirement. I'm like, why? Why am I going to make less in retirement? If I sit down and I strategize my real estate along with my stock market, my cryptocurrency, my whatever, your whole life policy, whatever you're doing, this is the opportunities to continue to be strong. I mean, if you're looking at, even if you take out that HECM loan balance and you don't pay it back, you're still ahead of where you would have been without using it. Or if I leave it there and I just use the additional line of credit with the increased value in my stock market, I have double what I started with. I have 1.9 million. You want to ensure that you have the kind of retirement that you're planning for. That whole idea of the survey of 1,100 people who are now retired, looking back going, I wish somebody had helped me understand that I should have saved more and started earlier. This is the information right here. What are you doing to plan with the information that you have, knowing that we're headed into a recession? We're going to continue to see home values increase. We're probably going to see interest rates drop. We're going to see opportunity. We'll probably see demand continue to increase. Real estate agents listening to this, you're going to see more opportunities probably next spring and be busy again, right? With anybody that was sitting on the sidelines now because emotionally they couldn't get over the fact that interest rates had hit 6. Well, news alert, they're back down into the 5s. I love that. So that's the conversation, picking up the phone, getting them out, looking at homes this weekend. Then the 2-1 buy down. And then I'm going to announce what we've got coming up next month. Super excited, Megan and I, and a special guest. But the 2-1 buy down is something that if you have a listing that is sitting there, and instead of doing a 3% price reduction, consider, I'm starting to see more people doing this, and I'm talking to realtors about putting this in the comments in the MLS, where the seller will provide the 2-1 buy down, limited to however much money. Because here's an example. If I took a $600,000 purchase, putting 10% down, used a 2-1 buy down versus a 3% price reduction. If I did a 3% price reduction, that seller would have to drop the price $18,000 right off. That's just they're going to feel $18,000 less proceeds, right? Instead, if the interest rates are 5.875, year 1, that buyer will have an interest rate of 3.875. Year 2, that buyer will have an interest rate of 4.875. And year 3 through 30, it'll go back to 5.875. This is what I'm talking about, where if you want to look at ARMs, you should also be looking at a 2-1 buy down, because if I'm willing to take the risk, or if I need to take the risk, I need to get an ARM because I need that monthly payment lower. Will this give me the same thing and give me the stability that I know the interest rate will never be higher than 5.875, because that arm, you need to ask the question. It has an introductory rate and it's set for a certain period of time. And then it goes up starting after that, usually every 6 months to a year. And then it has a lifetime cap. That lifetime cap is usually 5 to 6% higher than the initial rate. 5 to 6. Can you afford, if that interest rate goes up 5%? So if this gives me the same payment that I've been looking for to get with an ARM, but I have the knowledge and the stability knowing that my payment will never go above 5.875, not 8.875, because that's, if this is my ARM rate at 3.875 plus 5, it could go up to 8. That could really hurt. That is going to cost the seller $11,800 instead of $18,000. That is a win-win. So instead of jumping into a price reduction, try offering a 2-1 buy down for a buyer who comes in and offers full price. It's a strategy you need to know about. Now, here's another strategy you need to know about. Mike Sherrard is sharing all of his strategies on his systems and his social dominance. He was one of our keynote speakers, not one of our keynotes. He was one of our speakers at the Next Big Thing, one of the favorite speakers at the Next Big Thing. And he's coming down for a special event in July. We're going to have it at the Columbine Country Club. It is going to be limited because the space is limited. Megan and I will be there live. Her and I, our portion will be on Zoom, so you'll still get the market trends update if you don't want to join us at Columbine. There isn't a cost associated with it, but it is going to be capped out at right about 100 participants. So it will absolutely sell out, meaning there's no cost associated, but it will sell out. So make sure if you want to join us live, you'll see not only the market trends update, which will also be on Zoom and on Facebook Live, but you'll also be able to see Mike Sherrard share his systems and his social dominance techniques. And we are now on TikTok. We are having so much fun with this. I'm finding a joy side of me. Like, I have fun. I'm high energy all the time, but this has been a whole lot of fun. Make sure to join us on TikTok as well. Of course, you know, we're on YouTube and all the things, but I kind of make a fool of myself on TikTok. I'm just saying. All right. So with that, gosh, so much.
A couple questions for you.
Yes.
There was a slide a while ago. It was about 10:45 where you were talking about the numbers on the left of the housing versus recessions graph.
Yes.
What was the number on the left? Is that average sales price in thousands, or was that a different number?
That is the S&P Case-Shiller index. It's a housing index. So it gives us the percentages that home prices appreciation are going up or going down, but the number itself doesn't mean anything.
Okay. And then Sophia asked, what about assumable VA loans? How can we use that to help? Or it's challenging to find someone who qualifies to take it on?
The assumables are tough because last time we could use assumables when wages had dropped. You heard a lot about it and people using it. The problem with assumables is that buyer has to take over the loan, but the purchase price has gone up here given what's happened over the last 2 years. So if I have a loan amount of 150,000, but if I have a purchase price of 400,000, where are they coming up with the other 250? They're going to either have to qualify for a loan through that lender that has that VA loan, or they're going to have to bring cash. That's the problem with assumable loans here. They also, the VA specifically, and their VA or FHA, the VA assumable loans also runs a risk that if the buyer defaults on that loan, it can actually go back and hurt the veteran. So not a lot of veterans want to do assumables.
Oh my gosh.
Yeah.
Steve is asking if you can send out additional information on the 2-1 buy down.
Yes. We will put together some marketing materials on the 2-1 buy down.
Awesome. That's it for questions. Well, actually, there were some questions that popped up in the chats. Yep, more stuff on the 2-1 buy down. People are asking how to register for Agent Ignite.
We always send out the email. Megan sends out her email with her slide deck. We send out our email with a link back to the Facebook group. And in that, we'll also have the registration for the event.
And then are HELOCs always adjustable? Thank you.
HELOCs are always adjustable until you convert them to a HE loan. So you can fix a portion of the money that you withdraw from a HELOC and fix it at any time. Now it's going to be higher than market, but you can fix those. And you should look at doing that because HELOCs will go up exactly as the Fed rate goes up because they're tied to the prime.
Awesome. That's it for questions.
Look at us, 2 minutes early. We nailed
I
it.
know you guys get recess today. That's great.
2-minute recess. Run for the jungle gym.
Awesome.
I
Well,
would.
thanks guys for joining us. We always appreciate you joining us on Thursdays. We'll be back at it again next week on 10 o'clock next Thursday. So please come back and join us as we see if the market rebounds after this Juneteenth weekend or not. We'll have all the updated numbers for you. As always, we hope that we get to see you guys at our closing table. So keep us in mind for your future transactions, and we will see you guys later. Have a great rest of your week.
Bye.